Hi everyone, this is Stuart, and today's market update will cover the recent Federal Reserve meeting, the outlook for inflation and the economy, a potential opportunity in small cap stocks, and the latest in AI. Last week, the Federal Reserve announced a quarter-point cut to its federal funds rate. The median FOMC participant sees another 50 basis points of cuts this year, 25 more than in its previous meeting. While the cut was widely anticipated, more notable was the tension in the Fed's updated forecasts. To start, almost half of the FOMC expects just one or no more cuts this year. The policy statement flagged growing downside employment risks, yet officials marked up their 2025 growth estimates and lowered the unemployment rate estimates over the horizon forecast. The median participant now sees core inflation remaining persistently higher than before, yet also sees a need for more rate cuts. Why the dissonance? Either the committee has adopted a more dovish reaction function, or they're acting as if the labor market is much weaker than the employment rate shows. We think the former is more likely, but even if not, a dovish reaction function is poised to take over as President Trump appoints a new Fed chairman next year. On the inflation front, we can see that key metrics the Fed watches, core PCE, or changes in the prices of goods and services consumed by households, excluding food and energy, and core CPI, which measures changes in the prices consumers pay for a fixed basket of goods and services, again excluding food and energy, have leveled out around 3%. And given the trajectory of good and services inflation, it's difficult to see how we level out at 2% anytime soon. Recall that the Fed has a 2% inflation target. While formally expecting inflation to return to 2% over the long term, it's also possible that the Fed has quietly abandoned the 2% goal. As we'll discuss, that has material investment implications. Meanwhile, economic growth remains solid, with the real-time Atlanta Fed GDP Now estimate projecting 3% GDP growth for the third quarter. A loose monetary policy that lets inflation run at 3%, combined with solid economic growth, creates a healthy backdrop for financial assets. There are obviously risks. If inflation starts rising above 3%, or if the economy unexpectedly slows, but letting the economy run hot in the near term can inflate the prices of stocks in addition to those of goods and services. A solid economy combined with lower federal funds rates is a benign environment for small cap stocks, which tend to have more variable rate debt tied to the federal funds rate. Small cap stocks have materially underperformed their large cap brethren for 15 years, with returns for the Russell 2000 small cap index annualizing at 4% less than the large cap S&P 500 index since September of 2010. There are many reasons for this, but we think there's a catch-up trade given the interest rate and economic backdrop. We're happy to discuss potential ideas and review the risks separately. On the AI front, it's busy as always. A few key charts and updates we wanted to share. First, per the semiconductor research firm SemiAnalysis, the amount of compute in AI labs has tripled in just the last year. Second, per the widely followed AI analysis organization Model Evaluation and Threat Research, or METR for short, the length of tasks that AI can do is doubling roughly every 7 months. By the end of this year, the leading models should be able to handle tasks taking 1 hour to complete at a 50% success rate. That's up from just several minutes 2 years ago. This trend is bullish for the deployment in the near term of AI agents that can assist businesses and consumers in autonomously completing workflows. As we were putting today's slides together, NVIDIA announced plans to progressively invest as much as $100 billion in OpenAI as the company's partner to deploy at least 10 gigawatts of NVIDIA systems for OpenAI's infrastructure. To put that into perspective, 10 gigawatts is equivalent to the installed power generation capacity of the entire state of Connecticut. Finally, on the question of the sustainability of this investment, we turn to Meta CEO Mark Zuckerberg, who in an interview on the Access podcast said that the risk of underspending on AI was higher than on overspending, even if it means misspending a couple $100 billion. As we've said before, the leading AI firms are locked in an existential battle to become the first to achieve artificial general intelligence that can self-improve. At some point, we'd expect the pace of investment to slow down, just not anytime soon. Thank you for tuning in, and please let us know if you'd like to discuss anything we covered today. Have a great week.